If you are curious if you have to pay taxes when you sell your home, then you better watch this video. Well, that depends. If you are single, you will pay no capital gains tax on the first $250,000 of profit. Married couples enjoy a $500,000 exemption. However, there are some restrictions like with anything in life, and you will learn about them in this video, so listen up. So how much is capital gains tax on real estate really? To be exempt from capital gains tax on the sale of your home, the home, first and foremost, must be considered your principal residence based on the Internal Revenue Service rules. And these rules state that you must have occupied the residence for at least 24 months of the last 5 years. If you buy a home and a dramatic rise in value causes you to sell it a year later, you would be required to pay full capital gains tax, either short-term or long-term, on the house, depending on exactly how long you owned it, okay? However, if you've owned your home for at least 2 years and meet the principal residence rules, you may be able to exclude some or all of the long-term capital gains tax that would be owed on the profit. Single people can exclude up to $250,000 of the gain, and married people filing a joint return can exclude up to $500,000 of the gain. So short-term capital gains are taxed as ordinary income with rates as high as 37% for high-income earners, while long-term capital gains tax rates are 0, 15, 20, or 28% for small business stock and collectibles, with rates applied according to income and tax filing status. Ask your CPA about it. This rule even allows you to convert a rental property into a principal residence because the 2-year residency requirement does not need to be fulfilled in consecutive years, just cumulative months. Yes, you heard it right. So, for taxpayers with more than one home, a key point is determining which is the principal residence, right? The IRS allows the exclusion only on one's principal residence, but there is some leeway for which home qualifies. So, the 2 in 5 year rule comes into play here. Simply put, this means that during the previous 5 years, if you lived in a home for a total of 2 years or 730 days, that can qualify as your primary residence. So the 24 months do not have to be in a particular block of time consecutively, right? One caveat though, for married taxpayers filing jointly, each spouse must meet the rule. So a couple who married recently would not qualify for the $500,000 exclusion, even if one of them had owned the property for many years, okay? That's something to think about. Let's suppose you purchase a new condo for $300,000. You live in it for the first year, rent the home for the next 3 years, and when the tenants move out, you move in for another year. After 5 years, you sell the condo for $450,000. No capital gains tax is due because the profit, $450,000 minus $300,000 equals $150,000, does not exceed the exclusion amount of $250,000. Consider an alternative ending in which home values in your area increased exponentially, which happened actually in our area recently, right? So in this scenario, you sell the condo for $600,000. So capital gains tax is due on $50,000 because $300,000 profit minus $250,000 IRS exclusion. If your income falls into the 44-40-92 range for 2023, this is here, your tax rate is 15%. If you have capital losses elsewhere, you can offset the capital gains from the sale of the house with those losses and up to $3,000 of those losses from other taxable income. Ask your CPA about that. Requirements and restrictions regarding this rule. So as you can see, if you meet the eligibility requirements of the IRS, you will be able to sell the home free of capital gains tax, right? However, there are exceptions to the eligibility requirements, and the main major restriction is that you can only benefit from this exemption once every 2 years. Therefore, if you have 2 homes and lived in each for at least 2 of the last 5 years, you won't be able to sell both of them tax-free until more than 2 years have passed since you sold the first one. That makes sense, right? The Taxpayer Relief Act of 1997 significantly changed the implications of home sales in a beneficial way for us homeowners. Before the act, sellers had to roll the full value of a home sale into another home within 2 years to avoid paying capital gains tax. However, this is no longer the case, and the proceeds of the sale can be used in any way that the seller sees fit. Okay? On the other hand, when is a home sale fully taxable? Because not everyone can take advantage of the capital gains exclusion, I can imagine, right? So gains from a home sale are fully taxable when 1. the home is not the seller's principal residence. We talked about it, right? Number 2, the property was acquired through a 1031 exchange. We'll talk about it in a different video within 5 years. Number 3, the seller is subject to expatriate taxes. Different topic. Number 4, the property was not owned and used as the seller's principal residence for at least 2 of the last 5 years prior to the sale. Of course, some exceptions apply here. Number 5, the seller sold another home within 2 years from the date of the sale and used the capital gains exclusion for that particular sale. Okay, so let me give you an example of capital gains tax on a home sale. Real life example. Consider the following scenario. Susan and Robert, a married couple, purchased a home for $500,000 in 2015. Their neighborhood experienced tremendous growth and home values increased significantly. Okay, that rings a bell, right? Seeing an opportunity to reap the rewards of the surge in home prices, they sold their home in 2022 for $1.2 million. So the capital gains from the sale was $700,000, right? And as a married couple filing jointly, they were able to exclude $500,000 of the capital gains, leaving $200,000 subject to capital gains tax. Their combined income places them in a 20% tax bracket, so their capital gains tax was only $40,000. I hope this video gave you a clearer insight on what you will pay when you sell your house. In case of any tax-related questions, always contact your CPA. Now, look for part 2, and in the meantime, follow, subscribe, and like for more educational content like this. Thank you for watching.